What if I told you the dirt beneath your local auto repair shop is actually worth more than the massive national business operating on top of it?
It sounds crazy, but it's absolutely true right now.
Right. Today we are looking at why major retail brands are suddenly selling the ground right out from under their own feet and, what that means for you if you are trying to invest in commercial real estate in this environment.
Yeah, it's a massive shift.
Welcome to this deep dive into the source material, where we are extracting the absolute most critical, actionable insights from the latest retail commercial real estate, net lease, and 1031 exchange news for the week of July 17th through the 24th, 2026.
And if you're navigating this market, this really is the ground level intelligence you need to make sense of where the capital is actually flowing.
Exactly. And before we get into the heavy data, I want to establish right up front that this deep dive is brought to you by Eureka Business Group. They are your premier authority and broker for commercial real estate in the Dallas-Fort Worth market, specializing in retail.
Which is so critical right now.
It really is. I mean, when you are operating in an environment as nuanced and just fast-moving as this one, having a specialized authority in your corner is absolutely essential to finding deals before they hit the broader market.
Oh, absolutely.
Okay, let's unpack this. Looking at the overarching theme of the sources for this week, we are currently navigating a market phase defined by one very clear mantra, and that mantra is discipline, not compression.
Discipline, not compression. Yeah.
Right. It feels like the market is finally taking a breath and tightening its belt. It is not a crisis by any means, but it requires a much stricter financial diet for investors.
A stricter diet is a great way to put it.
Yeah, and I'm looking at the macro data, and with interest rates seemingly stuck on a plateau, it just feels like the easy money era is completely in the rearview mirror.
That is exactly the reality we're operating in. And the data backs up that feeling of a stricter financial diet perfectly. If you look at the capital markets backdrop right now, economists, polled by FactSet, expect the Federal Reserve to hold interest rates steady at 3.5 to 3.75% on July 29th.
Right, they're just not budging.
No, they aren't.
Yeah.
In fact, the CME FedWatch tool is showing roughly an 87% probability of a hold. So, you have a cost of capital that is plateauing, but it's plateauing at a very high elevation.
Yeah, it's a high plateau.
Exactly. And that sustained higher cost environment is forcing a slow, painful adjustment in pricing. Like the latest second quarter data from the Boulder Group illustrates this beautifully.
What do they find?
Well, they track overall single-tenant cap rates, and we saw those drift up 2 basis points to 6.82%, with retail specifically ticking up 5 basis points to 6.60%.
Okay, so a slight drift.
Yeah, it's a slight upward drift, but it is incredibly telling. I mean, it shows that sellers are finally starting to accept that buyers simply cannot pay yesterday's prices with today's debt costs.
Which makes sense.
Right. And we also have second quarter results from Getty Realty, which is a convenience and automotive net lease real estate investment trust.
Right, the REIT.
Yep. Their data shows that credit tenant retail yields are clearing anywhere from 7.4% to 8.2%.
Wow. Okay.
And that sets a very useful, tangible floor for private buyers who are trying to figure out where pricing actually lives in reality, rather than just on some optimistic marketing brochure.
That context is incredibly helpful, but it also creates a glaring question for me.
Sure.
If borrowing costs are staying higher for longer and, you can't just go to the bank and get a cheap loan at 3% anymore, how are these major retail operators actually unlocking the cash they need to grow or remodel or pay down their old debts without taking on punishing new interest rates?
What's fascinating here is that this exact capital squeeze is forcing operators to get highly creative with the assets they already control.
Okay.
They're increasingly turning to the sale-leaseback market to monetize their existing real estate.
Sale leasebacks, right?
Yeah. To understand how this works, think of a corporation's real estate portfolio as a massive, untapped piggy bank buried under their stores.
I like that analogy.
Right. Because when debt is cheap, companies ignore the piggy bank. They simply borrow against their balance sheet to fund expansion.
Because why not? It's cheap.
Exactly. But when debt becomes prohibitively expensive, they look down at the ground they are standing on and realize they are sitting on a gold mine.
Wow.
So they sell the physical property to a real estate investor, and they simultaneously sign a long-term lease to stay in that exact same building and continue operating their business.
Ah, I see.
The corporate operator gets an immediate massive injection of cash without taking on a single dollar of a new high-interest loan.
And the buyer?
For the buyer, it creates a brand new, single-tenant, net-leased asset with a guaranteed corporate tenant paying rent for the next 15 or 20 years. It is a brilliant, elegant solution to a high interest rate problem.
So it is essentially like finding out the house you've been living in is built on a gold mine.
Yes, exactly.
You sell the mine to an investor, take all that cash to pay off your credit cards or buy a new car, but you negotiate a contract to keep living in the house undisturbed.
That's a perfect way to look at it.
We are actually seeing that exact strategy play out in the sources this week with some major household names, like Cracker Barrel.
Oh yeah, that was a big one.
They just monetized 26 of their own properties through a $77 million net sale leaseback.
Which is a huge chunk of change.
Right. And they are using those proceeds strategically, simultaneously divesting the Maple Street biscuit chain to reduce their overall corporate debt and refocus on their core brand.
Yeah, cleaning up the balance sheet.
Here's where it gets really interesting, though. You have a slightly different strategy unfolding with Icahn Enterprises, which I found totally fascinating.
The Pep Boys deal.
Yes. They agreed to sell the Pep Boys operating business to Mavis for roughly $700 million in cash, but they deliberately and strategically decided to keep the real estate.
Yep, they kept the dirt.
To me, this looks like these massive companies are essentially admitting that the dirt under their stores is just as valuable, if not more strategic, than the business itself.
It really is.
So is this a warning sign about the fundamental health of running a retail operation today, or is it just a goldmine for real estate investors who are desperately looking for single-tenant inventory?
It is absolutely a goldmine for real estate investors, rather than a red flag for retail operations.
Really?
Yeah. What you are seeing with a move like the Pep Boys deal is a highly sophisticated strategic split between daily business operations and owned dirt.
Okay, break that down for me.
Well, running a national chain of auto repair shops, with all the payroll, inventory, and supply chain logistics that entails that, is a fundamentally different business model than managing a commercial real estate portfolio.
Oh, for sure. Night and day.
Right. And by separating the two, companies unlock trapped equity. When Icahn Enterprises keeps the Pep Boys real estate while selling the operating business to Mavis, they are making a calculated bet.
Which is what's...
They're recognizing that the underlying real estate, which is usually located on strong, high-traffic corner lots, will continue to appreciate in value and generate reliable rental income, regardless of whether the sign on the building says Pep Boys or Mavis.
That makes total sense.
And these service retail credit events create unique opportunities for landlords. They provide fresh, recognizable, single-tenant net lease inventory to the market.
Which the market desperately needs.
Oh, absolutely.
Yeah.
Now, consider the supply data we mentioned earlier from the Boulder Group.
Right, the cap rates.
Yeah. High-quality, investment-grade net lease assets. Think of your ground lease McDonald's or Chick-fil-A, the pristine properties that are still asking for cap rates as low as 4.45%. They make up less than 10% of the current retail supply on the market.
Less than 10%. That's tiny.
It is. The market is incredibly top-heavy with demand for premium assets, but the actual available product is remarkably scarce.
Wow.
Buyers are hunting for absolute security, but they are finding that safety comes with a hefty premium and very few options. So, when corporate restructuring unleashes a wave of new sale-leaseback inventory, it is exactly the mechanism needed to feed the acquisition pipelines of private buyers who are desperate for safe, yield-generating assets.
So if all this fresh capital is being unlocked through corporate sale leasebacks and all this new inventory is hitting the market, where is that money actually going?
Good question.
Because it definitely isn't flowing everywhere equally. The sources make it clear that this capital is highly concentrated and it's chasing demographic growth.
Very much so.
Which brings us directly to the specialty of Eureka Business Group, the absolute dominance of the Texas and specifically the Dallas-Fort Worth retail market.
It's just on fire right now.
It really is. CoStar explicitly categorized North Texas retail this week as a private capital feeding frenzy.
Feeding frenzy is the exact right term.
For example, we have a massive $45 million double trade happening right now in Mesquite. You have Blueprint Investment Properties buying the fully leased Broadmoor Plaza and Newport Capital Partners buying the Kroger-anchored Town Crossing. Both of these are sub-$20 million assets, and it seems like this specific price point is precisely the lane that private buyers are aggressively targeting to park their capital.
Yeah, that sub-$20 million threshold is a vital mechanism to understand if you want to know how the commercial real estate market actually functions on a daily basis.
Why is that specific number so important?
It is the ultimate sweet spot. It is
Yeah.
generally too small for the massive, multi-billion-dollar institutional pension funds or sovereign wealth funds to bother with.
Right, they need bigger deals.
Exactly. They need to deploy hundreds of millions of dollars at a time to move the needle on their returns.
Okay.
But concurrently, it is too large and requires too much capital for the average local mom-and-pop investor to take down.
That's right in the middle.
Yes. This dynamic leaves a very active, highly competitive, and incredibly lucrative lane for high net worth individuals, private syndicators, and 1031 exchange buyers.
And they are all flocking to Texas.
And the reason they are all flocking specifically to Texas is because the underlying economic fundamentals are absolutely undeniable.
The growth is just staggering.
It is. You have massive, sustained population migration, explosive job growth, and continuous corporate relocations to the Dallas-Fort Worth metroplex.
Which all feeds retail.
Right. All of those factors translate directly and immediately to retail demand. People need grocery stores, they need haircuts, they need coffee shops, and they need auto repair.
Yeah.
Interestingly, we are actually seeing the large institutions selling their assets into this demand. They're capitalizing on the aggressive private market pricing in places like DFW to trim their portfolios, while private buyers eagerly snap up the inventory.
And we are seeing that surging demand physically reshape the footprint of these Texas suburbs in real time.
Oh, absolutely.
For instance, the sources show a new Target coming to Anna, Texas as part of the Rosamond Town Center development.
That's a huge development.
It is. Over in New Caney, they are getting their first HEB, which will anchor the massive 400,000 square foot commerce district.
Which is just massive scale.
And even in existing spaces, Houston's highly competitive market is filling long vacant retail boxes with incredible speed.
Yeah.
We saw Burlington actively backfilling a 25,000 square foot former Saks OFF 50th location in Sugar Land just this week.
Right, they don't stay empty long.
They really don't. But going back to those new developments, I want to understand the ripple effect here.
Okay.
When a massive market maker like HEB or Target drops a new store into a growing suburb like New Caney or Anna, how does that instantly rewrite the underwriting math for a private investor who might be looking at buying a small, completely unanchored strip center right across the street?
If we connect this to the bigger picture, that is one of the most powerful dynamics in retail real estate.
Okay.
And it all comes down to the mechanics of the shadow anchor effect.
Shadow anchor, right.
When a behemoth corporation like HEB or Target commits to building a new location, they bring millions of dollars in proprietary consumer research, demographic forecasting, and spatial analytics with them.
They've done their homework.
Exactly, they do not guess. By the time they break ground, they have already mathematically determined that the specific trade area has the required household income, the population density, and the future residential growth trajectory to support their massive footprint for decades.
Wow, okay.
Now, if you are a private investor looking at a small, unanchored strip center directly across the intersection, that major retailer essentially acts as a shadow anchor for your property.
Even if they aren't in your center.
Right. Your smaller center doesn't have the Target brand on its own rent roll, and you aren't collecting rent from them, but your tenants directly benefit from the thousands of cars pulling into that intersection every single day to buy groceries or household goods.
The foot traffic is virtually guaranteed.
Because of that guaranteed traffic, the risk profile of your adjacent strip center drops dramatically overnight, which means the property's value increases proportionally.
That makes total sense.
Your local coffee shop or nail salon tenant is suddenly highly unlikely to default on their lease because they have a steady stream of Target customers driving past their front door.
Right.
This mechanism is exactly why specialized brokers like Eureka Business Group advise their clients to lean so heavily into necessity and service-anchored North Texas suburban centers.
Because it's a safer bet.
Yeah, but they don't just buy anything near a Target, you know. The underwriting standard they look for is incredibly rigorous.
What are they looking for?
You want a property with at least 80% necessity-based tenancy, meaning businesses people have to visit in person, regardless of the economy.
Like dentists or dry cleaners.
Exactly. And you need verifiable trade area rooftop growth, meaning new housing developments being built nearby before you even consider submitting a bid.
And the investors driving the fiercest competition for these necessity-based, shadow-anchored assets are the 1031 exchange buyers.
Oh, without a doubt.
For anyone unfamiliar with the mechanism, a 1031 exchange is a tax code provision that allows an investor to sell a property and defer paying capital gains taxes on the profit as long as they reinvest those proceeds into a new like-kind property.
Yep, it's a huge tax advantage.
But the catch is that they are operating on a brutally strict timeline.
Brutal's the right word.
The day they close on their sale, a countdown clock starts. They have exactly 45 days to formally identify a replacement property and a total of 180 days to close on it.
Tick-tock.
Exactly. If they miss either deadline, the exchange fails and they get hit with a massive tax bill.
Which nobody wants.
The sources highlight that the 2025 One Big Beautiful Bill Act successfully preserved Section 3031 into 2026.
Which was a major relief for the industry.
This is a huge deal because it means the pressure these buyers are feeling right now isn't about legislative threats or the government suddenly taking the program away. It is strictly about the operational discipline of identifying quality properties before the 45-day clock runs out. I can only imagine the sheer panic an investor feels on day 44 if their primary deal falls through and they have to scramble to find a replacement.
Oh, it's stressful. I've seen it.
To mitigate that risk, we are even seeing investors utilize partial exchanges, spreading their capital across multiple smaller assets to balance their portfolios and ensure at least part of the tax deferral succeeds.
Wow, that's becoming very common.
And for these hyper-motivated 1031 buyers, grocery-anchored centers are still viewed as the absolute holy grail of safety.
Oh, absolutely.
We saw a newly built, fully leased, Publix-anchored center in Jacksonville trade for over $20 million this week. That just acts as a textbook, pristine replacement asset for an exchange buyer.
Grocery has historically always been the ultimate defensive play for real estate capital.
Yeah.
It provides daily needs traffic that is highly resistant to both e-commerce disruption and broader economic downturn.
Because everyone has to eat.
Right. People still need to buy food, regardless of what the stock market is doing. That Jacksonville Publix trade is the perfect benchmark for exactly what a 1031 buyer wants to see when they are staring down the barrel of a tax deadline.
Brand new construction, right?
Yes. Brand new construction with zero deferred maintenance, a sterling corporate credit guarantee on the lease, and 100% occupancy, so the cash flow starts on day one.
The dream asset.
But while the conceptual demand for grocery is exceptionally high, the actual execution of buying these centers is becoming much more complex when you dig into the operational data.
Right, because the data from the sources presents a really fascinating contradiction that I want to explore.
Let's hear it.
While 1031 buyers are treating grocery centers like the ultimate safe haven, Globus reported that second quarter grocery transaction volume actually went south.
Yeah, deal velocity dropped.
Adding to that narrative, Albertsons, one of the biggest grocers in the country, is actively cutting its sales view and consolidating its massive operations down into just 4 regions.
Which is a huge structural shift for them.
It is. They are specifically citing cautious, highly price-sensitive shoppers as the reason for the pullback.
Yeah.
Meanwhile, if you look away from grocery, other retail sectors are moving in completely different, highly expansive directions.
Like value and service.
Exactly. The value and service categories are growing aggressively. Ross is opening 47 new stores. Basecamp franchising just hit its 300th store milestone.
Wow.
And Rita's Italian Ice is planning to double its new franchise signings in 2026.
There's massive growth there.
But conversely, you have Tractor Supply closing 75 of its smaller PetSense stores to reallocate their capital. And then you have the incredibly high-profile bankruptcy of Saks Global, which has completely derailed a massive $400 million Lord & Taylor redevelopment project in New Jersey.
A total mess.
So what does this all mean? I am looking at all this conflicting information, and I have to ask, we have 1031 buyers throwing premium money at grocery-anchored centers to beat the tax clock. But at the exact same time, second quarter grocery transaction volume dropped, and a giant like Albertsons is consolidating its footprint. Are real estate investors simply confusing a busy parking lot with a fundamentally profitable tenant?
This raises an important question, and your concern is highly validated by the underlying mechanics of retail operations right now.
Okay, unpack that.
Investors absolutely risk conflating top-line foot traffic with bottom-line operational health. Let's break down why that happens.
Yeah, please do.
A grocery store parking lot might look completely full on a Saturday afternoon, giving the landlord a false sense of security.
Because cars equal dollars, supposedly.
No, right. But if consumer price sensitivity is forcing that grocery operator to slash their margins just to move inventory, meaning shoppers are only buying the heavily discounted milk and eggs and avoiding the high-margin items in the center aisles, the actual profitability of that specific store location could be under severe stress.
Oh, I see. So volume doesn't always equal high profits.
Exactly. And this margin compression is exactly why transaction volumes in the grocery sector have slowed down.
It makes sense.
Institutional sellers want premium pricing based on historical safety, but private buyers are looking at the squeezed margins and demanding a discount for the increased operational risk.
Which creates a standoff.
Yes, that creates a widening bid-ask spread,
Yeah.
causing deals to stall out. For a 1031 exchange buyer who's operating under that strict 45-day tax clock, the advice here is to remain hyper-focused and highly analytical.
Don't just buy blind.
No, never. You must prioritize new construction credit-anchored assets where the corporate guarantee protects your rent, regardless of store-level margins.
Got it.
But more importantly, you must carefully scrutinize the renewal assumptions and the potential second-generation vacancy risks for the smaller inline tenants at those centers.
You mean like the local pizza place or the dry cleaner next to the grocery store?
Exactly. Because if the massive anchor tenant is squeezing margins just to survive the quarter, those smaller mom-and-pop shops in the same center are likely feeling even more intense financial pressure.
Oh, wow. Yeah. I didn't think of that.
And if they fail, that increases the risk of rollover vacancy, completely eroding the yield the investor thought they were buying.
That makes perfect sense. The underlying health of the specific tenant roster matters just as much, if not more, than the broad macroeconomic category they happen to operate in.
100%.
When you look at a value retailer like Ross successfully opening 47 stores, or a specialized brand like Tractor Supply selectively pruning 75 PetSense locations to improve their balance sheet, it highlights a fundamental truth.
Yep.
Commercial real estate is ultimately a derivative of corporate operational success.
That's the golden rule right there.
You cannot just buy a category like grocery or pet supplies and assume you are safe. You have to underwrite the actual business operating inside your four walls because
Yeah.
their ability to turn a profit is what pays your mortgage.
Exactly. And that dynamic is precisely why the Saks Global bankruptcy, derailing a $400 million redevelopment in New Jersey, serves as such a vital cautionary tale about execution risk.
Oh, that story is wild.
It really is. Redevelopment narratives often look fantastic on a glossy marketing brochure. The pitch is always that you buy a vacant anchor box at a discount, chop it up into smaller spaces, lease it out to trendy new brands at higher rents, and boom, you create massive value.
Sounds easy on paper.
Right, on paper. But when the master operating counterparty, the company supposed to anchor the new vision, fails and files for bankruptcy, the reality sets in.
Everything stops.
Yes, your construction lenders freeze their funding, the city halts your permits, your entire timeline explodes, and your projected return profile is completely destroyed.
And doing that on a 1031 timeline.
Imagine putting yourself in that situation as an exchange buyer, taking on heavy execution or redevelopment risk while actively fighting a 180-day closing clock is a recipe for an absolute financial disaster.
Yeah, that's terrifying.
If that deal gets delayed by a bankruptcy court, your exchange fails, and you owe the IRS all the taxes you were trying to defer.
Ouch.
This is why, especially in a market defined by discipline rather than compression, the focus absolutely has to remain on stabilized assets with verifiable, durable cash flows.
Right.
And this is particularly true in growth corridors like the Texas suburbs, where the demographic tailwinds, just the sheer number of people moving in every day, provide an extra critical margin of safety against tenant turnover.
It really is a landscape that demands incredible precision and a deep understanding of the mechanics behind the headlines.
Definitely.
To briefly recap the core journey we have taken through the sources today, we are clearly operating in a disciplined, elevated cap rate environment where borrowing costs are forcing adaptation.
The stricter diet.
Exactly. Corporate sale leasebacks, from Cracker Barrel to Icahn Enterprises, are doing the heavy lifting of feeding fresh, high-quality inventory to a very hungry private market.
Providing that supply.
And we are seeing a bona fide feeding frenzy in the booming Dallas-Fort Worth and broader Texas suburbs. That's driven by 1031 exchange capital and private equity chasing population growth.
Yeah, chasing those rooftops.
But beneath the surface of that frenzy, buyers must remain hyper-vigilant about the actual operational health and margin stability of their tenants.
Always.
Particularly in the historically safe grocery sector, where consumer price sensitivity is actively reshaping corporate strategy and footprints.
The overarching lesson to extract from this week's data is that strong macro fundamentals in places like DFW do not ever eliminate the need for rigorous property-level underwriting.
You still have to do the work.
You still have to negotiate fiercely on price, deeply examine the lease rollover risk of every single tenant, and thoroughly understand exactly how the business inside your building generates a profit in a challenging economy.
And navigating the complexities of that highly nuanced feeding frenzy is exactly why you need a specialized authority like Eureka Business Group in your corner for Dallas-Fort Worth commercial real estate.
Couldn't agree more.
When the market is moving this fast and the risks are this hidden, general knowledge simply isn't enough. You need specialists who live and breathe the granular dynamics of retail underwriting every single day.
You need an expert.
As we wrap up this deep dive into the source material, I want to leave you with a final thought to mull over based on the trends we have explored today.
What's that?
With specialized service categories like massive, high-tech veterinary clinics and subscription model car washes now trading with the exact same ferocity and cap rate compression as traditional necessity assets, what happens when the very definition of necessity retail shifts entirely?
Oh, that's a fascinating thought.
Right. 10 years from now, as consumer habits continue to evolve, will the traditional grocery anchor be replaced by an entirely new category of daily service that we haven't even conceptualized yet?
It's definitely something to watch.
Thank you for joining us on this deep dive. Keep your underwriting sharp, and we will catch you next time.